Welcome to Master Key Yard, accounting expert, where we provide services for accounting, lectures for ICANN, ECCA, CRS, CITN. Today we shall be looking at performance management, and the topic is marginal and absorption costing. Marginal and absorption costing. First of all, let's start with marginal costing. Marginal costing what is marginal costing? Marginal costing is an accounting system that determines the cost of production by considering only the variable cost. It considers only variable costs to determine the cost of production. It means that all the fixed production overhead are written off in full against the contribution. Now, let's see now what is the makeup of the cost unit under marginal costing. We have direct materials. We have direct material. We also have direct labor and direct expenses and variable production overhead. The summation of these four basic elements will give us the marginal cost of a product. Also note that in accounting, marginal cost means what? Direct or variable cost. Now, once we have this now, we can now calculate our contribution. Now, contribution is the difference between sales and variable cost. That is, in marginal costing, contribution is a key concept. That is, selling price minus variable cost will give us contribution. Hope up to this point there is no question. So let's see now how to calculate, how to prepare an operating statement using marginal costing approach. Lest I forget, when we say contribution, that is, it is contribution towards the recovery of fixed costs and making a profit. That is why your contribution C will be equal to fixed cost plus profit. All your fixed costs will be subtracted from the contribution to get your profit. Okay, let's look at contribution in full now. Contribution, like we said, that contribution C equals to selling price minus variable cost. Are we there? Now, you will be given the selling price in the question and the variable cost. And don't forget that your variable cost, like we said earlier, is the direct material plus direct labor plus direct expenses plus variable production overhead. The summation of these four is your variable cost. So let's take for example, example 1. Loveview Limited, selling price equals to 20 naira per unit. Over there. direct variable cost is given as 15 naira per unit. Therefore, what is our contribution? Recall that our C equals to what? SP minus VC. We are told that the SP is this 20 naira per unit minus our VC, which is the 15 naira per unit, give us 5 naira. 5 naira is our contribution. Hope is understood. Okay, welcome to Additionally PLC. This is another example on marginal costing. Our focus here is to show you how to calculate your contribution, such as contribution margin, that is contribution per unit. 2. Total contribution. 3. Your profit. Now, look at this question. We are told that Additionally PLC has the selling price to be 100 naira per unit, direct material, direct labor, direct expenses, variable production overhead. They are all in unit. Let's go. Solution. 1. Contribution margin, known as your CM, means what? Contribution per unit sold. It is CM equals to selling price per unit minus variable cost per unit. What is our selling price here? It's 100 naira. What is our total variable cost per unit? It is 10 naira plus 20 plus 5 plus 10. That is 10 plus 20 plus 5 plus 10. That will be 100 minus 10, 30, 35, and 45. That will give us 55 naira. This is our contribution margin. Our contribution margin. Contribution per unit sold. Number 2, let's look at now the total contribution. Total contribution. Now, total contribution has to do with the contribution you realize from the unit sold. Here, we are told that total units produced and sold equals to 2,000 units. Therefore, our total contribution will be contribution margin times unit. So, are we clear? That will be 55 naira times 2,000 units. That will give us, let's press our calculator to see, because 55 times 2,000, that will be 11,000, 110,000, sorry. This is our total contribution from all the units produced and sold. Is that clear? Number 3, our profit. Profit. Now, the third one is profit. I told you earlier that under marginal costing, our profit is usually gotten when we are gotten our total or marginal contribution first. Therefore, our profit will be total contribution minus total fees cost. Based on question 2, our total contribution is 110,000. And in the question, we were told that the total fees production overhead for the period is 2,000. Therefore, that will be 100,000 minus 2,000. That will give us now 108,000 as our total profit. Hope is clear. You must also get this basic link that under marginal costing is very essential for management decision making.